Dividend investing sounds boring, right? No hype, no overnight wins, no flashy headlines. But here's what most people miss: the math. While everyone's chasing fast money, dividend investors are quietly getting paid just for holding solid companies. Those payments get reinvested, buy more shares, and start compounding on themselves. Year after year, the income grows, the ownership grows, and the risk actually goes down. It's not exciting at first, but when you see how small, consistent dividends turn into massive long-term wealth, boring suddenly looks very smart. Today, we will talk about dividend investing sounds boring until you see the math. So before we start, make sure to hit the like button and subscribe to my channel. Reputation problem. Why dividend investing gets ignored? Dividend investing often gets dismissed as slow, old-fashioned, or something only retirees care about. In a world obsessed with fast growth, viral stocks, and overnight millionaires, the idea of earning a few percentage points a year in dividends sounds uninspiring. Social media glorifies explosive gains, not steady cash flow. As a result, many investors overlook dividends entirely, assuming they are sacrificing growth for safety. What most people fail to realize is that dividend investing is not about excitement. It's about mathematics, consistency, and long-term wealth mechanics that quietly outperform flashier strategies. What dividends really are, beyond the simple definition. At its core, a dividend is a portion of a company's profits paid directly to shareholders, usually in cash. But this simple explanation hides a deeper truth. Dividends represent realized business profits, not speculative future promises. When a company pays dividends consistently, it signals financial discipline, strong cash flow, and confidence in its business model. Unlike stock price appreciation, which depends on market sentiment, dividends are tangible returns that hit your account regardless of market noise. Psychological advantage of getting paid to hold. One of the most underestimated benefits of dividend investing is psychological. When markets fall, growth investors panic because their only reward is price appreciation, which disappears in downturns. Dividend investors, on the other hand, continue receiving cash even when prices drop. This steady income reduces emotional decision-making, prevents panic selling, and encourages long-term thinking. Being paid to wait is a powerful advantage most investors don't appreciate until they experience volatility firsthand. Math most people never calculate. Dividend investing becomes powerful when you stop looking at yields and start looking at time. A 3% dividend yield might sound small, but when reinvested consistently over decades, it creates exponential growth. For example, investing $10,000 with a 3% dividend and 6% annual price appreciation doesn't simply double over time. It compounds into several multiples of the original investment. The key is reinvestment. Each dividend buys more shares, which produce more dividends, which buy even more shares. This feedback loop is where the real magic happens. Dividend reinvestment, the hidden engine of wealth. Dividend reinvestment is what transforms dividend investing from boring income into a compounding machine. When dividends are automatically reinvested, you are effectively increasing your ownership in profitable companies without adding new capital. Over long periods, reinvested dividends often account for a majority of total stock market returns. Many historical market studies show that dividends and their reinvestment contributed more to total returns than price appreciation alone. Time is the multiplier, not yield. Many beginners obsess over high dividend yields, chasing stocks that pay 8%, 10%, or even more. This is a mistake. High yields often signal financial trouble, unsustainable payouts, or declining businesses. The real wealth builder is moderate, growing dividends held over long periods. A company that increases its dividend by 7 to 10% annually can outperform a high-yield stock that never grows. Time magnifies growth far more than starting yield ever could. Dividend growth, the income that fights inflation. Inflation quietly destroys purchasing power, making fixed income streams less valuable over time. Dividend growth investing directly counters this problem. Companies that consistently raise dividends increase your income faster than inflation, protecting your lifestyle without requiring you to sell assets. This is why dividend growth portfolios often outperform bonds and savings accounts over long periods while still providing income. Snowball effect, when income replaces effort. As dividend portfolios grow, something important happens. Income begins to replace labor. Early on, dividends might cover a small bill or expense. Over time, they grow large enough to cover rent, groceries, or even full living costs. This snowball effect is gradual but transformative. Dividend investing shifts wealth building from effort-based income to ownership-based income, a fundamental difference that defines financial independence. Market crashes, where dividend investors quietly win. During market crashes, dividend investors often experience less volatility and faster recovery. Quality dividend-paying companies tend to be established businesses with strong balance sheets. While prices may fall, dividends often continue, and reinvested dividends buy shares at discounted prices. This accelerates long-term returns. Many of the strongest dividend portfolios are built during bear markets, not bull markets. Dividends versus growth, a false choice. Dividend investing is often framed as the opposite of growth investing, but this is a false dichotomy. Many of the world's best companies offer both growth and dividends. Dividend investing doesn't mean avoiding growth. It means demanding that growth eventually turns into real cash returns. In fact, dividend discipline often forces companies to allocate capital more efficiently, reducing wasteful spending and shareholder dilution, tax efficiency, and strategic advantages. In many regions, qualified dividends receive favorable tax treatment compared to regular income. This makes dividend investing more tax efficient than selling assets for income. Additionally, dividends allow investors to rebalance portfolios without selling shares, reducing capital gains taxes and improving long-term efficiency. Why dividend investing rewards patience more than intelligence? Dividend investing doesn't require perfect timing, constant trading, or predicting the next big trend. It rewards patience, consistency, and discipline. Traits more reliable than intelligence or luck. Investors who stick with dividend strategies through market cycles often outperform. More active traders simply because they avoid costly mistakes, overtrading, and emotional decisions. Boring path that builds extraordinary wealth. Dividend investing feels boring because it lacks drama. There are no sudden spikes, viral screenshots, or overnight success stories. But boredom is often the price of reliability. While others chase excitement, dividend investors quietly accumulate shares, income, and ownership. Over decades, this boring strategy produces extraordinary results, not through brilliance, but through math. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.